Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And after a few weeks of what are arguably very strong, or actually one of the strongest rallies we've seen in the S&P 500 in quite some time, a lot of investors are turning to a much more positive and much more optimistic tone to the overall markets. But the question is whether or not that optimism is justified or there are some risks that we currently see here with our rally. That's what I want to discuss here today. Um, I think that it is reasonable to take the recent developments as a reason for us to be more bullish here on the markets. We have effectively erased the entire sell-off that we saw here as a result of the tariff tantrum, is what I'm calling it. The markets literally had a tantrum over the tariffs that President Trump tried to place on April 2nd. Market sold off very heavily. Not only did the equity market sold off, the bond market started um, suggesting some really painful days ahead. And obviously, the administration quickly reversed their decision, and that led to one of the biggest rallies we saw here in the equity markets. And then we had a little bit of volatility, but we've now erased fully that sell off here from the macro perspective. We're now even back above the 50-day moving average. We cleared back above 5,500 on the S&P 500, which is the major support level prior to the sell-off. That was the level that got broken on the sell-off. We've not only reclaimed that, we've gotten past the 50-day moving average. Now the question is, can we continue back towards all-time highs, or is there starting to be risks that build here to the downside? Now, here's the thing, we still have that 5750 major resistance level here up ahead. We really need to get back above those levels before I would say things look a lot more optimistic. As long as we stay below 5750, the bearish trend that started back here in March still remains intact. We still are making a series of lower lows and lower highs, unfortunately. And momentum has significantly slowed down on the rally here now that we've gotten back above the 50-day moving average. And then if you look at kind of the economic picture as well, even though the markets may have erased the losses from the tariff tantrum, what hasn't really been erased or resolved yet is the trade war. Not only has the trade war not been resolved, and hopefully in the next few weeks, we start to see some resolutions and some trade deals being done and see that as a positive news. But I think that the market has already sort of priced a lot of that positivity in, unfortunately. But what we are seeing is the impact of the tariffs have been in place for the last 4 weeks, 4 or 5 weeks now, meaning we have seen factory orders declined significantly in the past 4 to 5 weeks. We've seen shipping over the last 4 to 5 weeks decline significantly. And even if all tariffs and trade wars get resolved instantly today, the restart of all of that is not going to be a painless process. We saw what happened during COVID and the supply chains that got broken down effectively overnight. And then when we restarted things, there were a lot of growing pains, a lot of pain points, because if you think about the shipping industry is not designed to go turn on and off and go from major changes in terms of the amount of goods flowing through a port or the number of ships that are being sold. It's meant to be built. The entire infrastructure is meant to be built with very smooth operations. It's not made for stopping and starting very quickly. So we're starting to see this reflected in the earnings as well. We've seen quite a few earnings miss by a pretty significant margin, and most companies have now pulled their 2025 guidance as a result of the concerns that they have with tariffs and the expectations for further pain in later half of the year. Right now, most companies have enough inventory to get through the 4 to 5 weeks in terms of a pause in factory orders and shipping. However, The problem is when it restarts, it's not going to be smooth sailing. And the longer this goes on, the more painful that restart is going to be. And we're already seeing companies trying to mitigate some of those risks um, and provide guidance on those risks for the second half of this year. So particularly retailers, that source primarily their goods out of China are going to have a tougher time in the second half of this year, even if things get resolved right now. So we've seen jobless claims tick up a little bit higher here. We've seen unemployment tick up a little bit higher here. The job numbers last week were pretty strong here, but overall, consumers are getting more stretched. We're seeing the number of credit cards making minimum payments tick up significantly higher. We've seen delinquency rates pick up significantly higher. Consumer spending is clearly not as strong as it was a year ago. So can consumers continue to spend given the lack of consumer confidence that we see here, given the volatility we've seen here in the equity markets? Right now, my concern is that there's more risk ahead than clear blue skies ahead at the moment. So my view here on the S&P 500 is that as we get into this 5750 resistance level, as we've kind of rallied up, this is one of the best performing 1 month returns we've seen in the S&P 500. My concern is that we're going to see a retest of some recent lows, probably as low as 5100 here to the downside, given kind of the macro conditions that we're starting to see here out of both companies and as well as the economic data. So that's at a very high level my overview of where we currently sit on the equity market side of things. We see the same thing here on the NASDAQ 100. We managed to get back to this 492 double top here. This is really where the risk reward right now favors adding some bearish exposure here, especially within consumer discretionary and tech. And the great thing about that particular trade is that if the tech market gets back above, let's say the NASDAQ 100, the Qs get back above 500, the risk that you're taking on that trade is relatively small compared to the potential downside if you are correct on another pullback here in equities. So the risk to reward right now is more favorable to adding some bearish exposure or potentially hedging your portfolio rather than continuing to buy at these levels, hoping that the markets keep going higher. If you see IWM, small caps has barely gotten back above the 50-day moving average. Small cap companies looking far worse here than the mega cap names. The RSP equal weight S&P 500 index, as you can see, is struggling also as it continues to see just a series of higher highs and lower lows and lower highs. This is not a particularly good look for the S&P 500 from an equal weight perspective. So when you look at the majority of stocks in the S&P 500, yes, the mega cap names have kind of bounced back a little bit, but the rest of the names have not caught up, and that's not a particularly good thing for the equity markets. We continue to see growth outperform value a little bit here over the last couple of weeks, but as you can see, the overall trend here for the last few months has been to the downside where growth has underperformed value. Commodities has also bounced lower here, on the back of the fact that gold has pulled back from those all-time highs, and oil continues to sink. And we continue to see. I'll talk about oil actually here in a second when we get to the oil charts. The high yield bond market right now is still pricing in not a lot of stress in the markets. That is the one positive here, is the bond markets have not priced in a real credit crunch or a real concern around credit. But that is something that I do think investors need to start paying attention to, because like I said, we have seen delinquency rates tick up. We've seen minimum payments percentage of credit cards making minimum payments only tick up here as well. Those are signs that things are not all well from a consumer spending perspective, and 70% of the US economy is driven by consumer spending. We have seen VIX retreat here back to that 23% level. That does provide a potential opportunity for options buyers to be long volatility at the moment. And we do see treasury yields still remain fairly stuck here in this 4.3% level here, even though at the moment, we're pricing in 3 to 4 rate cuts here before the end of the year. And that is, largely due to the slowing economic data that we're starting to see come out of both um, uh, unemployment and consumer sentiment. Bonds have sold off again here recently at that 50-day moving average. So the rally here in bonds have largely stalled. The US dollar, as you can see, continues to kind of just trade below this $100 level here. We'll see if we can get a little bit of an uptick here in the US dollar here as we negotiate some of these trade deals and hopefully resolve some of the trade war issue. Gold, as you can see, retraced back from that 3,500 all-time highs, even though it's catching a little bit of a bid here again. But oil, this, as you can see, this is basically on the news that OPEC, or specifically Saudi Arabia, is trying to get the OPEC nations to continue to pump more oil and continue to try to push the price of oil lower, where to a point where it's below the break-even price of, let's say, the US and Canadian primarily the US and Canadian producers. It's really the Gulf states that can sustain, break even that's below, $50 at the moment. So oil making new 52-week lows is obviously going to be a positive for consumers that's fighting, inflation that continues to remain sticky and consumer spending that's in decline. But overall, what a lower price in crude is reflecting kind of also lower demand globally for oil, and that's not particularly a good sign when demand is lower as well. And then when we look at kind of the rotation here, we've seen a continued rotation recently back into tech. The question is whether that rotation can continue. Like I said, I think that there's a risk that that rotation sort of fails at this level here. When you look at XLK around that's 220 level here. So I'd be a little bit careful about continuing to go long tech at these particular levels, just because the risk reward is not particularly favorable. The upside here, I would think, is relatively small, meaning you face quite a bit of resistance here in the 220, 225 area, but the downside is pretty significant here to the downside. So the risk reward does not favor continuing to add more long positions here in tech. So if you've been on the sidelines and you're thinking to yourself, we've raised the tantrum from the trade wars, I think things are kind of getting back to a good place. Let me get back into the markets. I think that this is a level where you should be rethinking that specific mindset. I'm not saying that there aren't opportunities to be long. There certainly are, but you want to be far more selective and be careful to the downside. We also have seen a little bit of we continue to see kind of financials outperform here in the S&P 500, and industrials. Interestingly enough, industrials actually having a really strong start here to the last. I'm sorry, to the second quarter. Industrial is one of the few sectors that continue to see outperformance relative to the S&P 500. While on the flip side, we continue to see consumer staples underperform quite a bit over the last couple of weeks, after what has been a very strong outperformance for consumer staples. That is something that we do typically see when the growth cycle restarts, but I'm not sure how long this can particularly last. And if anything, this weakness here could be a potential buying opportunity for some of the more defensive sectors like consumer staples, healthcare. We've seen a pretty significant decline in healthcare over the last month, obviously because we've rotated from a more defensive tone to a more offensive tone here. And again, this pullback here, or this weakness currently in healthcare, potentially could be a buying opportunity. And we continue to see energy underperform. And that underperformance, I believe, will likely continue here in the short run, rather than be a driver here for the equity markets. So that's where we currently stand from a macro perspective. I'd say that we've had a really good month after what was arguably one of the more difficult times to navigate the markets here at the beginning of April. strong bounce back here in the S&P 500. And now that we've erased all those losses, we have to rethink whether or not things are back to normal or there's a lot of potential pain ahead. And unfortunately, based on what I'm seeing right now, based on the data, it looks like there's more likely some still pain ahead that isn't particularly priced into the markets right now. So looking at some ideas here for today, first let's start off with some of the bullish ideas here. Arista Networks. This is something that we've liked for quite some time, but we haven't added this to our bullish list here. But recently, as you can see, after what has been a kind of a challenging environment for Arista Networks, it started forming this bottoming formation. Some people like to call it a cup and handle, whatever you like to call it. It's a shift from a bearish trend back into a bullish trend here. It broke out above that $90 level here. It's outperformed the S&P 500 as it broke out. Those are things that we like to see as absolute strength alongside with relative strength. And Arista Networks, the thing that I like about this particular stock is the net margins. They have 40% net margins. So for every dollar they earn in revenue, they earn 40 cents in net profits versus around 10% for the industry. It is an expensive stock. It trades at 36 times forward earnings, but because of the high net margins and the high growth rates, they're expecting EPS and revenue growth rates in the 16, 17% range versus about, somewhere between 6 to 11% for the industry. So it's growing faster than the industry and it's far more profitable than the industry. And that's why, when you look for opportunities in this particular market, these are the types of names that you want to pay attention to here right now. Another one that I want to point you to is Intuit Software. We obviously just passed tax season here. Intuit Software, as you can see, recently kind of had this bottoming formation here as well, and we're looking for that potential breakout here. And it's recently outperformed the S&P 500 as it approached that level here. And then if you look at the fundamentals, it trades in line with the industry at around 28 times forward earnings, but it's expected to grow both top and bottom line faster than the industry, and net margins are sitting at around 18% versus 10% for the industry. So it's more profitable, it's growing faster, but valuation wise, it's trading in line with the industry. So that generally allows for some upside potential here. Another one I want to take a look at here is Zoom, right? We're using Zoom to do these webinars every single week. Something at this point that we kind of don't think about here very much here. But what I'm looking for is this potential breakout here. Not only has it kind of approached that resistance level, but it also has outperformed the S&P 500 over the last couple of months. Through all that volatility has outperformed the S&P 500. And what I love about Zoom is that it's trading at an valuation that's nearly half of the industry. It's trading at a 14 times forward earnings. Now, I think part of the reason that it's trading at such a low valuation is because, they haven't really grown revenues and earnings very much. We're talking about low single-digit growth in terms of EPS and revenue growth, but net margins of 22% is more than double the industry. So for every dollar they earn in revenue, they're generating 22 cents in net profit. So it is a very efficient company. They are generating they're very good at generating profits for their shareholders, and the fact that it trades at a valuation that's nearly half the industry represents significant undervalue of the stock. Even though it doesn't grow particularly very fast, it does print quite a bit of cash, free cash flow that it can return to shareholders. And that's why I think that Zoom very much should be trading back towards those recent highs, in the low 90s here to the upside, based on not only the charts, but also the fundamentals. And then one other chart that I want to point you to on the bullish side here is McDonald's. McDonald's, as you can see here over the last through all of this volatility, has been a star performer here, has outperformed the S&P 500 by a very wide margin here since the beginning of the year. Even though the stock doesn't look like it's doing much, keep in mind what's happened with the equity markets. McDonald's has been a very solid stock through that, and this is all because of the fact that obviously for McDonald's, they generate almost all of their stuff locally, so they're not particularly subject to the tariffs and the trade war. It's trading at only 25 times forward earnings, which is a slight discount to the industry. It doesn't grow as fast as the industry. It's slightly below the industry median in terms of growth rates, but where it really excels is how much profit it generates. Net margins are 32%. So for every $1 they generate in revenue, they're earning 32 cents in net profits. Then compare that to around 12% for the industry in terms of net margins, they're far, far more profitable. So even though they have a slightly below average growth rate, when you consider how fast they are, or I'm sorry, how efficient they are in terms of generating profits, the fact that they're actually still trading at a discount to the industry from a valuation perspective leads me to believe that, as McDonald's kind of broke out above this recent high, and that there's still a further upside ahead for a stock like McDonald's. Those are some of the bullish themes that we're currently seeing. Let's take a look at some of the bearish ideas that we're taking a look at. The first one we want to look at is Burlington Stores. Burlington Stores, obviously a retailer, and they source, a fair amount of their goods from Chinese sources. And, this is just a stock that is clearly on a recent decline here. You can draw your lines a few different ways, but either way, however you want to draw it from a timing perspective, it continues to make a series of lower lows and lower highs. And as it reaches that trend line, I think that timing works pretty well for a potential short exposure here. And, if you look at Burlington, it trades at 25 times forward earnings, which is not cheap for a retailer. And then you consider the fact that the industry is only trading around 18 times forward earnings. You're talking about a stock that's trading at nearly 50% higher valuation than the industry. Now, for a company to be justified to trade at that type of valuation, it better be growing significantly faster. And in my opinion, it should be more efficient than the industry, but it's not. It is growing faster than the industry. There's no doubt about it. And that's part of why it's trading at a richer valuation than the industry. EPS growth is closer to about 20%. Revenue growth is closer to about 10%. So that outpaces the industry by a pretty wide margin. And for those reasons, it is justified that Burlington trades at a higher valuation. But net margins are only about 4 to 5%. So meaning for every $1 they generate in revenue, they're only printing 5 cents, 4 to 5 cents in net profit. Those are very thin margins. And in a world where tariffs and trade wars are a reality going forward, and you look at kind of the conditions of what the second half of 2025 is going to look like, that's really where my biggest concern is that you're likely going to see some margin compression. If that 4 to 5 cents that they're earning goes down to 2 or 3, these valuations are you can't sustain those valuations even if you're growing faster than the industry. So for those reasons, I see some risks with Burlington stores. The next one I want to take a look at here is Team. Now, this is a tech stock. Recently, as you can see, this is a stock that continues to make a series of lower lows and lower highs, and kind of like kind of that XLK chart or the Nasdaq 100 chart. It reached back to this 240 double top level here, and it recently traded off of those double tops. And I think that there's going to be a retest of the recent lows into that 170 level here to the downside. And this is really where valuations and profitability comes into play. It's trading at 48 times forward earnings. So very, very expensive stock, nearly double the valuation of the industry. It is growing faster than the industry. There's no doubt about that. 21% EPS growth, 20% revenue growth. That's nearly double what the industry is doing. But net margins are negative, meaning at the moment, for every $1 they earn in revenue, they're actually losing about 8 cents as a net loss on the company. So in type of environment, stocks that are not profitable or companies that are not profitable are not going to do particularly well when things hit the fan a little bit. So that's why Team is on my radar as a potential bearish trade. Next one I want to take a look at here is T-Mobile. T-Mobile, as a telecom company, has done incredibly well. There are some signs that strength is starting to weaken here, and particularly, the relative strength chart. This outperformed the S&P 500 this whole year, But as you can see recently, it really has taken a bit of a cut here. It broke down below the recent lows from a relative perspective, came back to retest it, and looks like it could be starting to see some further downside here. And just look at the chart. This is a chart that is starting to roll over here, right? However you want to draw your lines, this is a support level around 250, 255 that has been broken, and now we're retesting 255 as resistance. And my concern is that there is some downside ahead for T-Mobile. Now, T-Mobile trades at a very rich valuation, 23 times forward earnings, versus the communications sector generally trades at around 10 times. So you're talking about a valuation that's more than double the industry median. So for those reasons, I think you have some concerns here for T-Mobile just from a valuation perspective. Now, the reason it trades at a rich valuation historically is because it grows significantly faster. You compare it to AT&T and Verizon, T-Mobile grows at head and shoulders above those two companies. You're talking about EPS growth that's approaching 16% versus the industry's 8%. Revenue growth that's approaching 5% when the industry is around 1.5. So again, head and shoulders above in terms of growth rates, but net margins are just in line with the industry, 14% versus 13%. So if there is any reduction in that growth rate, and that's one of the things that we have seen consistently in earnings this particular quarter, are companies that are lowering their outlook for the rest of the year, or if not pulling their guidance. We've seen the pullback in consumer spending. That is likely going to have a small impact here on companies like T-Mobile. And just the valuation at more than double the industry is the biggest risk that I see here right now with T-Mobile. The next one I'm going to take a look at here is Walmart. Walmart has managed to hold on substantially here through this trade war, and has been one of the beneficiaries. One of the better stocks throughout this trade war. As you can see, throughout this last month has outperformed the S&P 500, but we're near this major double top here. And, while Walmart is likely going to be able to navigate the supply chain issues here better than most companies just because of their sheer size, they also are, at the biggest risk because of how much they source their goods from China. And like I said, supply chain shocks that are likely coming in the next few months, I don't think is properly priced into the markets, especially for big retailers like Walmart. Walmart's trading at 37 times forward earnings, which is incredibly high for a company that only earns about 3 cents in net profits for every $1 they generate in revenue. These retailers, you forget how thin their margins are. They operate on razor thin margins. They're kind of like airlines from that perspective. Obviously, retailers are a lot more stable than airlines. You don't have, a single crash that can really kind of shake people's perception of safety or, and things like that. So you don't have those types of external shocks. So they're far more stable companies. But because of that, they operate on very, very thin margins because of how competitive the industry is. And when you add supply chain shocks to that, this is really where, the fact that it trades at a valuation that's more than double the industry average valuation is around 17. Walmart's trading at 38 times forward earnings. So we're talking about, effectively more than double the industry. So, and it's not growing any faster than the industry either. It's not like Walmart's growing head and shoulders faster than the industry that justifies a higher valuation. It's not more profitable and it doesn't grow any faster, yet it trades at a valuation that's more than double. And that's what I see a big risk here with stocks like Walmart right now. So that's my view here for the broader markets. There are some risks ahead now that we've had a good month off of that volatility from the beginning of April. But I think that we need to be real about what is up ahead. And I think that's something we need to be aware of. With that, that covers what I wanted to share with you here today. I hope that this is helpful in helping you navigate the broader markets. Thank you so much and have a great trading day.